Hey guys, Rahul Chayar, trying to make investing accessible and profitable for the average investor. Now, let's start today's session with a small thought experiment. Imagine that there are three investors in a small town, investor A, B, and C, and they have rupees 1 lakh each to invest. And they can invest only in two companies, company 1 and company 2, and there are no other companies out there. Three investors with 1 lakh rupees each, only two companies. The stock market index is also made up of these two companies only, company 1 and company 2, and each company having a 50% weightage in the index. So an index with just two companies, 50% weightage each. Now of the three investors, investor B, he says that I'm going to invest my 1 lakh in the same proportion as the index. So I'm going to put 50,000 in company 1, 50,000 in company 2. A and C, on the other hand, consider themselves to be smart investors, consider themselves to be smart stock pickers, and therefore they don't want to invest like the index or like investor B. They think that they can, with the smart stock picking, choose stocks that are likely to do better than the index. And therefore what investor A does is he feels that company 1 is going to do better than company 2, therefore he puts the entire 1 lakh rupees into company 1. And investor C, on the other hand, believes that the company 2 is going to do better than company 1, and therefore he puts his entire 1 lakh in company 2. So investor A is putting 1 lakh into company A, investor B 50,000 each, investor C 1 lakh into company B. At the end of the 3-year period, what happens is company 1 goes up by 100%, company B does not move much, its price remains the same. Company 2 does not move much, its price remains the same. So company 1 goes up by 100%, company 2 does not move much. So now let's see what kind of returns each of these investors have earned. Investor B would have made 50% of his money, 50% returns on his money, because he invested 50% in each, and since company 1 went up by 100%, he earned 50% of those returns, and he did not make any money on company 2, and therefore his overall returns is 50%. Investor A, on the other hand, who's bet all his money on company 1, he earns 100% returns, his money doubles because he's not put any money in company 2, therefore he's done much better than investor B and has doubled his money. Investor C, who's not put any money in company 1 but put all his money in company 2, he earns zero returns. Because his investment did not move much or stayed flat throughout, he did not make any money on his investments. Now investor B makes 50%, investor A makes 100%, and investor C 0%. What I just explained to you is a miniature version of the actual stock market. The actual stock market is of course much bigger, much complex than this, but the underlying principle remains the same. The actual stock market, does not have two companies in its indices and its index. It has 30 companies, 50 companies, 100 companies. It can have even 500 companies comprising the index, and it does not have only three investors. It has millions and millions of investors. The actual stock market, the underlying principle remains the same. When it comes to the actual stock market, again there are three different kinds of investors. Investors of the kind of investors that exhibit a behavior similar to investor B. They believe that they cannot devote the time and effort required to pick stocks, and therefore they believe in investing in the index, and they make index-like returns over the long term. Investor A and investor C, on the other hand, consider themselves to be smart stock pickers, and there are of course millions and millions of investors like this out there. They believe that they can, because of the skill that they possess, they can give better returns than the stock market index, and therefore they do their own stock picking. However, what they don't realize is that the outperformance of one investor comes at the expense of the underperformance of the other investor. Like in the example we just saw, investor C does not make any money. He makes zero return, and investor A has doubled his money. So the 50% gap has come out of investor C. The outperformance of investor A has come out of investor C. And this is what happens in the stock market day in and day out. If you want to outperform the benchmark index, if you want to do better than the benchmark index, then the index investor, your outperformance will come at the expense of someone else's underperformance. So if the stock market has given 15% returns over the long term, and if you've earned 30% returns, there's someone out there, some investor out there, or a group of investors out there who made zero money on their investments over the last few years so that you could make 30%. And this is, how stock market works. And I think what a lot of people don't realize. Warren Buffett, one of the world's smartest investors, in his most recent AGM, he mentioned that the average investor cannot beat the index. There's a very low probability that he'll be able to beat the index over the long term. In fact, he went to the extent of saying that if investors have a choice of investing between Berkshire Hathaway and an index fund, the investor should put his money in the index fund and not Berkshire Hathaway if he has no knowledge of stocks. Berkshire Hathaway has outperformed the index phenomenally over the last 50 or more years. And still, Buffett feels that the average investor, if he has no knowledge of the stock market, he should invest in an index fund because he is not confident, or he is not sure that Berkshire Hathaway will end up outperforming the benchmark index over the long term. Of course, he's being a little modest, and given the kind of stock picker that he is, there's a very high chance that over the next 10 years, Berkshire Hathaway will end up outperforming the benchmark index. But he is sending out a warning to Robinhood investors. Now, Robinhood investors are investors who've taken to stock picking only recently. They have opened their accounts on the famous Robinhood app. They have, hopped onto the Robinhood bandwagon by the millions. And given the pandemic situation, all they are doing is trading in and out of stocks, moving in and out of stocks, trying to outperform the benchmark index. But they have to realize that they are up against a fierce competitor. They are up against people who've spent years in the stock market, who are much wiser than them by virtue of their experience. They put in a lot more effort and a lot more hard work. And if they think that they can outperform the benchmark index, whereas the other investors will underperform because one person's outperformance is other person's underperformance, they would be making a big mistake. Warren Buffett believes that these Robinhood investors are better off investing in an index fund rather than trading in and out of stocks, because over the long term, there's a very small chance that they'll be able to outperform the benchmark index. I think, I believe that this is true in India as well. A lot of people have opened demat accounts in India also over the last year and a half, and they have taken to stocks very actively. They are trading in and out of stocks, and they're making merry at the moment. They're making a lot of money, but they have to realize that if they have to beat the benchmark index, their outperformance will come at the expense of the underperformance of other people out there. And among those other people are some very smart people, some very smart fund managers who've been in the market for decades, who have tons of experience, who have access to research. They know the nature of the beast, and therefore there's a very high chance that the trading activity or the investing that they are doing can end up in tears because of their very little experience in the stock market. There's a very famous saying that stock market is a place where people who have experience meet people who have money, and after some time people who have the money, they have the experience, and people who have the experience, they have the money. So a clear-cut indication from this message, a clear-cut message from this quote is that for new investors who cannot put the time and effort required to study stocks and properly analyze them, they are better off investing in an index fund. Index fund is one of the best options out there if you have to cash in on the India growth story. The stock market index, the BSE Sensex, I think has returned some 15-16% over the last 40 odd years in the stock market, which is very good in my view, and there is no reason why it can continue to give this performance over the long term. And therefore, if you want to participate in the India growth story over the next decade, there is no other investment or no better investment than an index fund in my view. And therefore investors should have a lot of while they learn the tricks of the trade, while they are learning investing, only a small portion should be allocated to their individual stock picking, to their trading activity, and a large percentage should go into an index fund. Because as I just mentioned, it's very difficult for an individual investor to outperform the benchmark index given the competition that's there out there, and given how one's outperformance is other person's underperformance. So their outperformance will have to come at the expense of the underperformance of someone else. And consistently outperforming the benchmark index over the long term is very difficult because of the smart competition that you are up against. Therefore, if you have to do well in the stock market over the long term, by all means learn investing, learn trading, do all those activities, but you need to spend some time in the market, spend some years in the market to develop a proper investment process or a proper investment system. You need to have those skill sets, and while you build those skill sets, allocate only a small portion to the trading activity and allocate a large portion to something like an index fund, so that you can participate in the India growth story. At the same time, do not end up paying that guru dakshina to the stock market, where you're learning a bitter lesson or having a bitter experience only after losing a lot of money in the stock market. So in order to avoid doing this, have a large portion of your money in the index fund while learning the tricks of the trade and learning to invest properly in the stock market. So that's all from my side today. I'll see you again next time. In the meanwhile, keep those comments, likes, dislikes coming. They really encourage us to put out better quality feedback, better quality output. So keep the feedback coming, and I'll see you again next time. Thank you so much.